You know what keeps me up at night? It's not the charts. It's not the technical indicators. It's the emails I get from retirees who watched silver sit at $15, $18, $20 for years while everyone told them gold was the only game in town. And now, right now in December 2025, silver just shattered its 1980 all-time high and is trading above $55 an ounce. Let me say that again. Silver broke a 45-year-old record. And if you're sitting there thinking you missed it, you need to hear what I'm about to tell you. Because here's what nobody's talking about. When silver broke $50 back in 1980, it crashed back down within weeks. Hunt Brothers manipulation, margin hikes, the whole thing collapsed. But this time is fundamentally different. And I'm going to show you exactly why the next 12 to 18 months could represent the single greatest wealth transfer opportunity for retirees holding silver that we'll see in our lifetimes. Let me start with something that happened 3 weeks ago that barely made the news. The Shanghai Gold Exchange, that's China's official precious metals market, reported physical silver withdrawals hit an all-time monthly record. We're talking 847 metric tons pulled out of registered vaults in a single month. Now, you might be thinking, okay, so what? Here's the so what. The entire global silver market produces about 26,000 metric tons per year. China just pulled 3.2% of annual global production out of available supply in 30 days. And they're not selling it. They're vaulting it. Permanently. But it gets better. Or worse, depending on which side of this trade you're on. The COMEX, that's the New York Commodities Exchange where silver futures trade, just reported registered silver inventories dropped to 67 million ounces. That sounds like a lot until you realize that's down from 215 million ounces in January 2024. We've lost 69% of available deliverable silver in less than 2 years. And here's the kicker. Open interest, meaning the number of paper contracts betting on silver prices, is sitting at 180,000 contracts. Each contract represents 5,000 ounces. Do the math. That's 900 million ounces of paper claims on 67 million ounces of physical metal, a 13-to-1 leverage ratio. Now, I want you to imagine something with me. Imagine you're at a casino, and 13 people are holding tickets that say they own the same poker chip. As long as nobody asks to actually hold that chip, everything's fine. Everyone's happy. But the moment even 2 or 3 people walk up to the cage and say, "I'd like my chip, please," the whole system breaks. That's where we are with silver right now. And retirees, you need to understand this because you're the ones who actually want the physical metal, not the paper promise. Let me tell you about what happened in 2011. Silver hit $49.80 in April of that year. I remember it vividly because I was watching the COMEX trading floor and you could feel the panic. Within days, the exchange raised margin requirements 5 times. 5 times in 9 days. They made it so expensive to hold silver futures that speculators had no choice but to sell. The price crashed from $49 to $26 in 2 weeks. It was brutal. But here's what's different now. In 2011, that move was driven by speculators, hedge funds, fast money. This time, it's driven by industrial demand, sovereign nations, and a supply deficit that's been building for 3 consecutive years. The Silver Institute just released their 2025 market report, and the numbers are staggering. Global silver demand hit 1.2 billion ounces this year. Total supply, including recycling, was 1.03 billion ounces. That's a 170 million ounce deficit. And it's not a one-year thing. We ran deficits in 2023 and 2024 too. We've pulled 400 million ounces more silver out of the ground than we've put back into available supply over 3 years. Where's that silver going? Solar panels? Electric vehicles? 5G infrastructure? And it's not coming back. When you put silver into a solar panel, it's gone. It's not like jewelry you can melt down. It's embedded in technology that gets installed on rooftops for 25 years. Now, let me connect this to something that matters to you as a retiree. In 1980, when silver hit $50, the gold-to-silver ratio was 17-to-1, meaning it took 17 ounces of silver to buy 1 ounce of gold. Today, even with silver at $55, that ratio is sitting at 48-to-1. Gold's trading around $2,640. So silver would need to hit $155 an ounce just to match the historical relationship we saw at the last silver peak. Now, I'm not saying we're going to $155 tomorrow, but I am saying that if you're a retiree who bought silver at 20, 25s, even $30 an ounce over the last few years, you're sitting on something that's historically undervalued relative to gold by a factor of 3. And here's where it gets really interesting for the retirement crowd. Central banks have been buying gold at record pace. Everyone knows that. But what people don't realize is that silver is starting to show up on sovereign balance sheets in ways we haven't seen since the 1960s. India just announced they're adding silver to their strategic reserves. Not gold, silver. Why? Because they're building out the world's largest solar infrastructure program, and they need to secure supply. Mexico, the world's largest silver producer, is now keeping 15% of domestic production for national strategic purposes. They're not exporting it, they're stockpiling it. Let me paint you a picture of what's happening in the physical market right now. I've got contacts at major bullion dealers, and they're telling me wait times for physical silver delivery have stretched from 2 weeks to 6 weeks. American Silver Eagles, the most popular coin for retirees, are trading at $8 to $10 premiums over spot price. That means if silver is $55 on the screen, you're paying $63 to $65 for an actual coin in your hand. That premium was $2 to $3 2 years ago. The premium is telling you something. It's telling you there's a massive disconnect between paper price and physical availability. Now, I want to take a quick 30-second detour here because this is relevant. If you're sitting on $100,000 or more in traditional retirement accounts, 401ks, IRAs, that kind of thing, and you're thinking about how to get exposure to physical silver without taking a taxable distribution, I put together a free guide on how precious metals IRAs work. It's in the description below. Covers the whole process, the rules, the custodians, how to actually get physical metal into a tax-advantaged account. Worth checking out if that's your situation. All right, back to why this silver move is just getting started. Here's something that's going to blow your mind. The U.S. Geological Survey just updated their estimates on global silver reserves. They now estimate there are 560,000 metric tons of economically recoverable silver left in the ground worldwide. At current consumption rates of 32,000 metric tons per year, that's 17.5 years of supply. But here's the catch. Consumption isn't staying flat. It's accelerating. Solar panel installations are growing at 25% per year. Electric vehicle production is doubling every 3 years. Each EV uses about 1 ounce of silver. We're going to produce 20 million EVs this year. That's 20 million ounces right there, and that number is going to 40 million, then 80 million over the next decade. Let me tell you a story about what happened in the palladium market, because it's a perfect preview of what's coming for silver. Palladium is used in catalytic converters for cars. In 2016, it was trading at $500 an ounce. Everyone thought it was boring. Industrial metal, whatever. Then automakers started ramping up production and supply couldn't keep up. By 2019, palladium hit $1,600. By 2022, it touched $3,400 an ounce. A 580% move in 6 years. Why? Because you can't make a catalytic converter without it, and there's no substitute. Silver is in the exact same position with solar panels and electronics. There is no substitute that works as well at any price point. Now, let's talk about what's happening in the derivatives market, because this is where things get spicy. The big commercial banks, and we're talking JP Morgan, HSBC, the usual suspects, have been net short silver for years. They sell paper contracts to suppress the price while they accumulate physical metal. It's been documented. They've paid billions in fines for manipulation. But something changed in the last 6 months. The Commitment of Traders report, which shows positioning in futures markets, just showed commercial shorts at their lowest level in 15 years. The banks are covering. They're getting out of their short positions. You know what that means? It means the smart money thinks the price is going higher, and they don't want to be caught on the wrong side when it does. Here's another piece of the puzzle that retirees need to understand. The dollar is losing its grip as the global reserve currency. I know, you've heard this before. But look at what's actually happening. The BRICS nations, Brazil, Russia, India, China, South Africa, plus 40 other countries that just joined or applied to join, are settling trade in local currencies and gold, not dollars. Saudi Arabia just signed their first oil deal denominated in yuan. That's never happened before. When the dollar loses reserve status, even partially, all those dollars that have been sitting overseas for decades come flooding back home. That's inflation. And when inflation comes, retirees run to hard assets. Silver is the poor man's gold. It's accessible. You can buy it in smaller increments. And it moves faster than gold when the monetary system gets shaky. Let me give you some specific numbers on what analysts are projecting. Goldman Sachs just put out a research note saying they see silver at $60 to $65 by mid-2026. Bank of America is more aggressive. They're calling for $75 to $80 if industrial demand continues at current pace. But here's the one that caught my attention. A small research firm called Metals Focus, which specializes in precious metal supply chains, published a report saying that if we see any kind of supply disruption, a major mine closure, a trade war that impacts Mexican or Peruvian exports, anything like that, silver could spike to $100 within 90 days, not over years, within 90 days, because the market is that tight. Now, I want to talk about something that doesn't get enough attention, the recycling problem. With gold, about 30% of annual supply comes from recycled jewelry and electronics. People melt down old rings, old coins, whatever. But with silver, recycling only accounts for 15% of supply. Why? Because silver is used in such small quantities in each application that it's not economically viable to recover it. There's 0.2 grams of silver in your smartphone. It costs more to extract it than it's worth. So that silver is effectively lost forever. Every year, we're losing millions of ounces of silver into landfills and obsolete technology that will never come back to market. That's a one-way trip, and it's tightening supply permanently. Here's something that happened last month that should terrify anyone who's short silver. The Perth Mint in Australia, one of the largest silver refiners in the world, announced they're running at 100% capacity and still have a 6-month backlog on orders. They can't produce silver bars and coins fast enough to meet demand. The Royal Canadian Mint is in the same boat. The U.S. Mint suspended sales of silver eagles twice this year because they ran out of blanks. These are government mints. They have unlimited resources, and they can't keep up. What does that tell you about the supply situation? Let me connect this to the retirement picture specifically. If you're 60, 65, 70 years old, you remember what happened in the 1970s. You remember when inflation was running at 13%, 14% per year. You remember when a gallon of gas went from 30 cents to 1.20 in 5 years. You remember when your savings account was paying 5% interest, but inflation was eating 12% of your purchasing power every year. We're heading back into that environment. The government is running $2 trillion deficits. The Fed printed $5 trillion during COVID and never took it back out of the system. That money is still sloshing around the economy. And now we've got a new administration talking about tariffs, trade wars, more spending. This is the exact recipe that created the 1970s inflation crisis. And in the 1970s, silver went from $1.50 to $50, a 3,200% move. Now, I'm not saying we're going to see a 3,200% move from here, but I am saying that if silver goes from $55 to $150, that's a 173% return. If you've got $50,000 in silver right now, that becomes $136,500. If you've got $100,000, that becomes $273,000. And unlike stocks, unlike bonds, unlike real estate, silver doesn't have counterparty risk. You hold it in your hand. Nobody can print more of it. Nobody can dilute it. Nobody can take it away from you. For retirees on fixed incomes watching their purchasing power erode, that matters. Here's another angle that's not getting enough coverage. The green energy transition is mandated by law in most developed countries. The European Union has legally binding targets to be carbon neutral by 2050. That requires a complete overhaul of their energy infrastructure. Solar, wind, batteries, electric grids, all of it requires silver. The U.S. just passed the Inflation Reduction Act with $369 billion in green energy subsidies. China is spending $500 billion per year on renewable energy. This isn't speculation. This is government policy with money already allocated. And every single solar panel requires 20 grams of silver. We're installing 200 gigawatts of solar capacity per year globally. That's 4,000 metric tons of silver just for solar. And that number is going to double by 2030. Let me tell you about what's happening in the mining sector, because this is critical. Silver doesn't come out of the ground by itself. About 70% of silver production is a byproduct of mining other metals, copper, lead, zinc. So when copper prices are low, mines shut down and silver production drops even though silver prices might be high. Right now, we're seeing major copper mines in Chile and Peru dealing with labor strikes, environmental protests, and aging infrastructure. These mines produce millions of ounces of silver as a byproduct. If they slow down or shut down, silver supply drops immediately. And there's no way to make up that shortfall quickly. It takes 10 to 15 years to bring a new mine online from discovery to production. Here's a specific example. The Peñasquito mine in Mexico, one of the world's largest silver producers, just announced they're dealing with water shortages and community opposition. They might have to reduce production by 30% next year. That's 18 million ounces of silver that won't come to market. Where's that supply going to come from? It's not. The market will just have to do without it. And when you've got 170 million ounces of deficit already, losing another 18 million is gasoline on a fire. Now, let's talk about what happens when the paper market breaks, because it's going to break. It's not a question of if, it's when. Right now, the COMEX has 67 million ounces of registered silver, but there are 900 million ounces of paper claims on that silver. The system works as long as only 7% of contract holders ask for physical delivery. The moment that number goes to 10%, 15%, 20%, the exchange will do one of two things. They'll either raise margin requirements to force people out of their positions like they did in 2011, or they'll declare force majeure and settle contracts in cash instead of metal. Either way, the paper price becomes meaningless. The only price that matters is what you can actually buy physical silver for, and that price is going to be multiples of whatever the screen says. I want you to think about what happened with nickel in 2022. The London Metal Exchange had a short squeeze where nickel prices went from $25,000 per ton to $100,000 per ton in 48 hours. The exchange literally shut down trading and canceled trades. They rewrote the rules in the middle of the game because a Chinese company was about to default on billions of dollars of contracts. The same thing can happen with silver. The exchanges are not your friend. They will change the rules to protect the big players. That's why physical metal in your possession is the only thing that matters. Here's something else retirees need to consider: estate planning. If you pass away and leave your kids stocks or bonds, they're going to pay capital gains on the appreciation. But if you leave them physical silver, they get a stepped-up basis. Meaning if you bought silver at $20 and it's worth $100 when you die, your heirs inherit it at $100 with no capital gains tax on that $80 gain. They only pay tax if they sell it for more than $100. That's a massive tax advantage that nobody talks about. And if you hold silver in a Roth IRA, which you can do, all the gains are completely tax-free. You could buy silver at $20, watch it go to $150, and never pay a dime in taxes if it's in a Roth. Let me give you another historical parallel. In 2008, during the financial crisis, silver dropped from $20 to $9 in 6 months. Everyone thought it was dead. But then, from 2009 to 2011, it went from $9 to $49, a 444% move in 2 years. Why? Because the Fed started printing money and people realized the dollar was being debased. We're in the exact same setup now. The Fed printed trillions during COVID. They're talking about cutting rates again. The government is spending like there's no tomorrow. This is the environment where silver thrives. And this time we've got the added catalyst of industrial demand that didn't exist in 2008. Back then, solar was a niche market. Now it's mainstream. Back then, EVs were a joke. Now they're 15% of global car sales and growing. Here's what's happening in the options market that's really interesting. Call options on silver, that's bets that the price will go higher, are trading at record volumes. But here's the kicker. The most popular strike prices are $75, $100, and $125. Traders are betting on silver doubling or tripling from here. And they're not buying short-term options. They're buying contracts that expire in 2026 and 2027. That tells you the smart money thinks this move has legs. This isn't a quick pop and drop. This is the beginning of a multi-year bull market. Now, let me address the elephant in the room. What if I'm wrong? What if silver crashes back to $30? Here's the thing. Even if it does, which I don't think it will, you're still holding a tangible asset that has 5,000 years of history as money. Silver has never gone to zero. It's never been worthless. Can you say the same about stocks? About bonds? About the dollar itself? Every fiat currency in history has eventually failed. Every single one. The average lifespan of a fiat currency is 27 years. The dollar has been off the gold standard since 1971. That's 54 years. We're on borrowed time. And when the dollar finally loses its reserve status completely, silver is going to be one of the few things that holds value. Here's a specific scenario I want you to consider. Let's say we get a banking crisis. Not a full collapse, but a regional bank failure like we saw with Silicon Valley Bank in 2023. People panic. They pull money out of banks. They look for safe havens. Where do they go? Gold and silver. But here's the problem. There's not enough physical metal to meet that demand. The premiums explode. Overnight, you're paying $20, $30, $40 over spot just to get a coin. I've seen it happen. In March 2020, when COVID hit, silver premiums went from $2 to $8 in 2 weeks. Dealers ran out of inventory. You couldn't buy silver at any price. If you already own it, you're golden. If you don't, you're scrambling to get in at the worst possible time. Let me tell you about what's happening with silver ETFs, because this is important. The largest silver ETF, SLV, is supposed to hold physical silver to back every share. But there's been controversy for years about whether they actually have all the metal they claim. Audits are rare, transparency is limited. And here's the thing, if there's ever a run on that ETF, if everyone tries to redeem it once, we're going to find out real quick whether the metal is actually there. My bet? It's not. At least not all of it. And when that comes to light, the price of physical silver is going to gap up so fast it'll make your head spin. Here's another piece of the puzzle. China just announced they're building a strategic silver reserve. Not for investment, for industrial security. They're worried about supply chains. They're worried about being cut off from Western markets. So they're stockpiling silver the same way they stockpiled copper and rare earth elements. When a country of 1.4 billion people with the world's largest manufacturing base decides they need to secure silver supply, that's a game changer. They're not buying paper contracts, they're buying physical metal and putting it in vaults. That's supply that's never coming back to market. Let me give you one more historical example, and then I'll tie this all together. In 1999, silver was trading at $5 an ounce. It was dead money. Nobody wanted it. Then, from 1999 to 2011, it went from $5 to $49, a 880% move over 12 years. But here's what's interesting. It didn't move in a straight line. It had pullbacks. It had consolidations. But the overall trend was relentlessly higher. And the people who made life-changing money were the ones who bought early and held through the volatility. The ones who tried to trade in and out got chopped up. The ones who held physical metal and ignored the noise made fortunes. So here's where we are right now. Silver just broke a 45-year-old record. It's trading at $55 with momentum behind it. We've got a supply deficit that's been building for 3 years. We've got industrial demand that's accelerating. We've got central banks and sovereign nations stockpiling. We've got a paper market that's leveraged 13 to 1 and ready to break. We've got a dollar that's losing reserve status. We've got inflation that's not going away. And we've got a green energy transition that's mandated by law and requires massive amounts of silver. For retirees, this is your moment. You've been patient. You've held through the boring years when silver did nothing. You've watched gold get all the attention. But silver's time has finally come. And the move we're about to see is going to dwarf anything we saw in 1980 or 2011, because this time it's not speculation driving it. It's fundamental supply and demand. It's physics. You can't build a solar panel without silver. You can't make an EV without silver. You can't run 5G networks without silver. And we're running out of it. The analysts calling for $60, $75, $100, they're being conservative. If we see any kind of supply shock, any kind of delivery default on the COMEX, any kind of banking crisis that drives people to physical assets, we could see $150, $200 even higher. And it could happen fast. Not over years, over months. because the market is that tight and that leveraged. So if you're sitting on silver right now, congratulations. You made the right call. Hold it. Don't get shaken out by volatility. Don't sell into the first pullback. This is a multi-year move, and we're just getting started. And if you don't own silver yet, if you've been on the sidelines waiting for the right time, I'm telling you, this is it. This is the moment. Because 6 months from now, when silver is trading at $80 or $100, you're going to wish you acted today. The time for retirees with silver has finally come. Don't let this opportunity slip away.